It's great to be with all of you. Before I begin my remarks, let me just kind of introduce a few things that are relevant to me. I'm particularly happy to be able to address the Friedberg Institute, since Albert Friedberg and I first encountered each other in 1985, and I started working initially as the chief economist for the Friedberg Mercantile Group, and it was a fabulous friendship and business relationship and professional relationship, and you name it. So I'm just delighted to be with you today, mainly because of my good friend Albert Friedberg. Point number one. Now, point number two, that was 1985. In 1988, I believe, I really became deeply involved with economic policy aspects in Israel with Alvin Rabushka. That's a long story. Let me just give you the summary. We published a blueprint for economic growth in Israel in 1988, and it was Al Friedberg, who at Friedberg Mercantile Group, who actually sponsored the publication of that document. Now remember, Meridor was the finance minister at the time, and that was the first kind of acorn that was planted in Israel to start reforming the economy and getting it out of the socialist bog that it was in. In those days, by the way, May Day was the big celebration. That was the big day in Israel, May Day, if you can believe it or not. And socialism was deeply entrenched. And we, of course, were very free market oriented. And I think some of the reforms that eventually took place, privatization, deregulation, tax rationalization, and so forth in Israel, were actually the result of that original work that Alvin and I did, that Al supported fully. So with that introduction, let me begin talking about inflation. And in that regard, there's a real problem with terminology. Once you get to talking about inflation, there's just mass confusion about even the basic terminology involved. And let me give you an example that'll drive this home. In around 2010, something like that, Routledge Publishers contacted me and asked if I would write a chapter in the Routledge Handbook of Major Events in Economic History. And they invited me to write on hyperinflation. And I said I would do it under one condition, and that is that I would present something in a table form that documented every hyperinflation that's ever occurred in world history. And to be included in the table, I would be able to, I would need to find the primary data and replicate all the calculations for every one of these hyperinflations. Well, it turned out that was an onerous task. Fortunately, I had a wonderful assistant at the time, Nick Cruz, who worked literally 2 years on this project. It was unbelievable, the amount of work to gather actually the real primary data, redo all the calculations, and determine whether hyperinflation had actually occurred. Now that gets to a definition. What is hyperinflation? Hyperinflation, since 1956, has been the custom and practice in the economics profession after Phil Kagan, Professor Kagan, wrote a classic article on hyperinflation, 1956, and he just arbitrarily defined it as 50% per month. If you hit 50% per month, you qualified as hyperinflation. Since then, I've been able to refine it because I can use high frequency data, so I have 50% per month for 30 consecutive days. So that's a definitional thing. Now, how many times in the press, if you Google every single day, you will find all kinds of references to hyperinflation is just broken out someplace, or hyperinflation exists someplace. Well, it doesn't. There have only been, in our original Hanke Cruise hyperinflation table, which we published in that Routledge handbook, and it was published in 2013, there were 58, only 58 hyperinflations in world history. Since then, we've added 4 more, and we're up to 62. So they're pretty rare events. And by the way, the 62nd one was your neighbor, Lebanon. In July, I measured it, and hyperinflation broke out in July. That's the only MENA country, Middle East, North African country, that's ever experienced hyperinflation. So hyperinflations are very rare. Now, the other little footnote here that's kind of interesting is that Josh Bluestein and Jonah Bennett and I, two of my best students, we decided that we would look at the ghettos in the World War II era and see if inside the ghettos we could get any primary data on price increases. It turns out in the Lodz ghetto, we found the data, all the primary data, very, very carefully taken care of. And Lodz did have a hyperinflation. So we haven't published this yet, but the 63rd hyperinflation in world history is going to be the ghetto. So that's introduction into inflation, extreme inflation, very rare and very difficult to kind of get your head around, because 50% a month is a lot of inflation. That's a big price increase. That's my first point. Definitions are very important when you're looking at economics. Second point gets into definitions, and that's we have something called relative price changes and something called inflation. And relative price changes, think of it this way: when you have something like the consumer price index, you have, as they always, the image they give us is that you have a basket of goods and services, and inside the basket, you've got all these goods and services, and you measure where the level of the basket is. If you have a weighted average of everything in the basket, you will come up with a price level. The price level will be someplace, and that looking at that price level, going from one point to another point, that is a change in the consumer price index or the producer price index, or you name it. There are just so many indices that they have, but those are baskets. Those are aggregates that include lots of goods and services. I mean, most consumer price indices have hundreds of items in them. Some may have over 300 or 400 items. That's the absolute or aggregate change in the price level. And what we normally call inflation is where the basket is. If the basket's moving up, you have inflation. If the basket's going down, you would have deflation. Now, relative price changes. Relative price changes are the movements inside the basket of the various prices of goods and services contained in there. And those relative price changes are due to changes in demand and supply conditions for the particular items that are in the basket. Now, by the way, if you read the quarterly reports from Friedberg Mercantile Group, Al Friedberg describes this very, very well. And I will be talking now about work that John Greenwood and I have done in collaboration. Bob mentioned this when he read about the letter to the Wall Street Journal yesterday. But John Greenwood and I, of course, have been in contact with Al Friedberg, and Friedberg, of course, figured out this relative price thing before it even happened almost. But if you look at what's going on in the press now, everyone's talking about relative price changes. They're not really talking about inflation. So keep that in mind. Now, let's talk about the basket and the price index for a minute. We know what changes the relative prices, changes in demand and supply. The supply of oil gets cut back and the price of oil goes up. Semiconductors, we have now a big shortage of those, so the supply curve has shifted to the left, and we've got a price increase. Used cars, we have a shortage of used cars. If you have a shortage of something, the price goes up. Demand outstrips supply, and to equilibrate the market, the price goes up. So all of these things we're reading about, supply chain, anything in the supply chain we're reading about, those are all relative price changes due to shocks and changes in the demand or supply for whatever it happens to be in the supply chain. Now, what about the basket? What about the price index? That's inflation. It's not relative prices, it's inflation in the basket. So what moves the basket up and down? The only thing that moves the basket up and down, as Milton Friedman taught us a long time ago, inflation everywhere and always is a monetary phenomenon. That means what? It means that you have to have some change in the money supply, correctly measured and broadly measured, that drives prices, makes them go up or go down. And there's something called the quantity theory of money. This is, of course, Milton Friedman 101, quantity theory of money. And what is the quantity theory of money? How do you really get at it? Well, it's very simple. Since about the 16th century, we've had the quantity theory of money that's been formulated in one way or another. But since the late in the 19th century, we had something called the equation of exchange. And the equation of exchange is MV. If you're taking notes, MV. Money is M. V is the velocity of money, how fast it turns over on an annual basis. And that's equal to P, and P is the price index. And Y is the real growth in the economy. So equation of exchange, MV, money times velocity, equals P, the price index, times Y, which is the real level of economic activity. And the best way to think about Y, it's just the potential growth rate in the economy. In the US, it happens to be, it's more or less about 2%, something like that. So that's what's called an identity. It's true by definition. And that is the equation that you have to manipulate if you're going to figure out anything with regard to the current rate or the expected rate of inflation. Now, that thing that Bob was reading about, where Greenwood and I said in July that by the end of this year in the United States, the inflation rate would be 6% or maybe as high as 9%. And we're clearly going to be right on. The current inflation rate 6.8% in the United States as of November. We got that by the arithmetic of the equation of exchange. You can work all this out very, very well, not so easy, maybe, but it is if you're used to it. It's not a complicated thing. It's really arithmetic. But the key thing, of course, is getting good measurements to put in the M and the V and the Y. The Y is easy. I already told you that's 2% in the United States. But at any rate, that's the basis of the thing. Again, to summarize, the basket goes up and down because of the quantity theory of money and the changes in the money supply. Money supply gets excessively growing at an excessive rate, and the basket goes up. You got inflation. And if it's too slow, of course, you've got deflation. That's what they've been having for decades in Japan, for example. Very slow growth in the money supply, and as a result, you get almost no inflation whatsoever, and to some extent, you've had deflation in Japan. Now, everything you're reading in the press, however, is dealing with relative price changes, all this supply chain nonsense that they're talking about, that is all talk about relative price changes, not inflation. It has nothing to do with inflation. It's changing relative prices, one against the other, that are in the basket, and those are changing because demand and supply is shifting around. Now, this is important. I'm going to get to my third point now. The first point was the hyperinflation and definitions. Second point was what makes relative prices move and what makes inflation, or the absolute level of the index basket, going up and down. The third point is what we're seeing in the press, and all you're seeing in the press are these ad hoc explanations for inflation. In other words, supply chain problems, used car prices going up, oil prices going up, gas prices going up, ports being plugged in Long Beach and Los Angeles. COVID in general is just a blanket thing. Those things do not cause inflation. They cause relative price changes. What causes inflation is the money supply. Now, this gets to my Hanke's 95% rule. And Hanke's 95% rule is that 95% of whatever you're reading in the financial press is either wrong or irrelevant. In other words, the relative price change thing and supply chain problems, those are interesting. But they're irrelevant when it comes to talking about inflation, and nothing to do with inflation. Now, why are they talking about this so much? This is a political thing. And it's a political thing because none of the politicians, and particularly the people at the Federal Reserve and the central banks, want to take any responsibility for having produced excess money that is driving the inflation. They want to talk about all kinds of ad hocery things that they claim are causing inflation. They aren't causing it, of course. The central banks aren't causing it. And so that is why you're reading the press. The journalists have bought into this 100%. Now, not only that, but I can also say the markets have bought into it, and we'll talk about that in just a moment. Let me make one remark that I forgot to make when I was talking about the quantity theory of money and the equation of exchange, and that is the flow of these surges in the money supply. Once the money supply becomes excessive, its growth becomes excessive, then the question is, well, how does this affect things? I mean, how does this work into inflation? And what happens, you have the following flow that's very important. The money starts surging. And after that, with a lag of about 1 to 9 months, asset prices go up. Now, this has happened in the United States in spades. That's why the stock market, of course, went booming, because the surge in the money supply, which I will talk about in a minute, started in March of 2020 when COVID broke out and they started shutting the economy down. They put the pedal to the pedal to the metal and accelerated the money supply. The fastest growth in the money supply we've had since World War II occurred in early 2020 until about the mid-year 2020. So asset prices have gone up. I come from the state of Iowa, and I just had an email this morning. The headline in the Des Moines Register was, farmland values have gone up 29% this year to a record level. They haven't reached this rate of growth in 80 years. Those are assets. Those are real assets. So step one, money supply goes up. Then within 1 to 9 months, asset prices start to surge. Then within 6 to 18 months, real economic activity starts surging. That's growth in real GDP. Then, with a lag of 1 year to 2 years, inflation starts kicking in. So we're just getting the real monetary kick in of inflation now, you see. It's been almost 2 years since we've had the initial surge in the money supply in the United States. So that sequence is very important, particularly if you're in the markets. Asset prices go up, then economic activity revs up, then the last thing that happens is inflation. And actually the last thing that happens after that, interest rates follow inflation. Long-term interest rates follow inflation. So they will be the last thing to go up and adjust. Now, let me go to my fourth point, and that's again talking about this relative price chain and supply chain problems. If you look at China, Japan, and Switzerland, all three of those, the price level isn't going up, and the basket's staying about constant. And why is that? Because in China, Japan, and Switzerland, the money supply is well managed and remaining about constant. So in all of those places, China, out of those three countries that I just mentioned, it has an inflation rate of about 2.5%. It's below 1% in Japan and Switzerland. But this is getting into the relative price change problem. So that's where the basket is. No, stable. The money supply, pretty stable. Okay, that explains inflation. What about the relative price change? The relative price change in China and Japan and Switzerland, they have all the same supply chain problems, all of these ad hoc reasons that are given to explain inflation. All three of those countries have those, but they don't have inflation. And they don't have an inflation problem because they don't have an excess money supply production problem. They're managing things pretty much along the lines of the quantity theory of money, that equation of exchange, MV equals PY. If they want to hit a price target, which would be P in that equation, they put the price, they're doing it. You rearrange the equation and you solve for M, and you will find out that their M is just about where it should be to hit the inflation target P that they've plugged into the whatever their central banks are plugging in. Also, you can look historically, by the way, if you want to look back at the oil shocks. Remember, the oil shocks of the 70s were a big deal. And everyone was saying, oh, OPEC, the Arabs are causing all this inflation around the world. It's terrible. Well, this is just nonsense. If you look at the first oil shock in Japan, Japan did have elevated inflation. It did increase after the first oil shock in the 1970s in Japan. But it did because the money supply was increasing. They were accommodating the relative price change in oil by big increases in the money supply, and they had inflation in Japan. The second oil shock that hit in the late 1970s, Japan did not accommodate with increases in the money supply the relative price boost caused by OPEC, and Japan didn't have inflation. So this is making this distinction between inflation and what causes it, the money supply, and relative price changes that are caused by demand and supply chain, demand and supply changes. Now, let's look at some different countries, and we'll get into, when we do this, I want to talk about something that Greenwood and I call the bathtub. We use a bathtub kind of visual or analogy to talk about inflation and excess money creation and whether this is going to cause inflation. So you have a bathtub, and of course, as everybody knows, you have a faucet going into the bathtub, and the monetary bathtub as a monetary faucet. So the money supply is going into the bathtub, and the bathtub has two drains. One drain is the money that's required to accommodate real economic activity, growth and real economic activity. And that would be in what I just told you earlier. In the United States, that's more or less 2%. So real growth is about 2%. You drain out enough money to accommodate that, okay? And you also have something else going on. If you look at the velocity of money in that equation of exchange, you have the velocity, but if you invert that, you have something called the Cambridge K, and the Cambridge K actually is the demand for money. The inverse of velocity is what's called the Cambridge K. That's a demand for money, and that's a drain that drains some of the money out. As the economy grows, people demand more money. They have more money in their savings accounts. They have more money in their money market accounts. They want more liquidity. So as people get richer, they want to hold more money in their portfolio of assets. So that's another drain that drains something out. And so what you're left with in the bathtub, if there's anything left in it, after you have those two drains running and the faucet going, if there's something left, that's excess money in the bathtub. And that excess money eventually goes out the overflow valve. As I said, with a lag of about 1 to 2 years, it'll start going over the overflow valve. And that's the inflation valve. So what do we end up with in the United States? Let me just go through these countries. I've been talking exclusively about the United States. I'm going to talk in just a second about Israel. You're more interested in Israel than you are in the United States, obviously. The United States, the amount of money expansion measured by M sub 2, which is the broadest measure of money that the Federal Reserve accounts for. It's too narrow, it's inexact and so forth, but that's it. That's what they measure, M2. It's increased by a little over 36% since March of 2020. And if you net out the two drains that I told you about, we end up with an excess, the increase that is excess, 27.2%. Now, that excess is going to go over the overflow valves. And depending on, and so we know that the price index, the basket, the index going from where we are now to some higher future index will be 28.2% higher than where it is right now. Okay? So the question is, well, how do you spread that out over time? If you take 3 years to 4 years, which is a good historical norm for looking at these excesses, and just divide 3 into 28.2 or 4 into 28.2, you get a range of inflation that's 7% to 9.3%. That's the annual rate of inflation. If you spread it out over 3 years, you get a little over 9%. And if you spread it out over 4 years, you're going to get around 7%. So this means all this talk we've been, and what you see in the press about transitory inflation is nonsense. This inflation is going to be persistent. We've already got the excess money in the bathtub. We know it's got to come out. This is baked in the cake already, no matter what the Fed does. And by the way, that excess is calculated on the following basis. It's pretty conservative because Greenwood and I assume that the Fed will taper and will reduce the rate of growth in the money supply from its current 12+% per annum to something like 6% per annum, which would be a rate that would be consistent with hitting their 2% inflation target. So we assume they so-called taper and they slow things down. If you assume that, you've still got all this excess money in the bathtub. The Fed is not going to drain that out, by the way, and the federal government is not going to drain it out. Forget that. It's going out the excess, the overflow valve. So let's do the same thing for Israel. This is going to be a shocker because I said that the current inflation rate is already 6.8% in the United States. So the numbers I gave you and the numbers Greenwood and I published in July in the Wall Street Journal, that's not really a shocker. We're already there. But if you look at Israel, the last inflation number that Israel's published is October. The last one in that 6.8 in the United States, by the way, is November. But Israel, what's the inflation rate in Israel? As of October, it was only 2.3%. Now, let's look at the bathtub. Israel has been one that's created a tremendous amount of excess money since COVID. The total increase is almost as great, measured by M3, as the United States. It's 33.3%. You take out money from the two drains, the real economic growth and the demand for money. The demand for money, by the way, is very high in Israel. It's about 3% per year. The US, it's only 1.7%. But at any rate, you subtract those out, and what are you left with? In the bathtub, excess money, 19.7% in Israel. So if you divide that out on a 3-year basis, you would have an average inflation of 6.7%. If you let it stretch to 4 years, you've got 5%. So even under a conservative assumption of 4 years, stretching it out quite a bit, you're going to have inflation in Israel that's double what it is right now. And why do I say that with such certainty? Go back to the equation of exchange. The equation of exchange is an identity. It has to be true. It's an identity. So it's very, very, very simple. You're going to be in for a lot of inflation in Israel. Welcome to the club. United Kingdom is the next country. Their excess is only about 11%. It's about half of what it is in Israel. So they'll have a little bit of elevated inflation, but certainly not nearly as much as the United States or Israel. Then we go to Australia. 7.7 excess. It's even less than the United Kingdom. Eurozone, not much at all. 7% excess since COVID started. Canada, not much. 7.3. A little. They're kind of. You've got basically Australia, Eurozone, and Canada kind of in a mid zone. Then we've got New Zealand. It's only 4.4% excess. Japan, only 3.5, Switzerland, 0.9, and look at China, minus. They have a deficiency in the bathtub, minus 1.4. So I would say that for New Zealand, Japan, Switzerland, and China, I would anticipate a negligible changes in the price index from where it is right now. You'll have a little bit more in Australia, Eurozone, and the United Kingdom coming up on top. But the two countries that stand out are United States and Israel. They're going to have persistent, troubling inflation in both those countries, given what I've just told you. Now, my last point, and I've already almost taken too much time, I think, but my last point, what do the markets think about this? And the markets, this is incredible. the markets, I'm talking about the market in the United States now, the bond market. The bond market is priced in over, if you look at the forward curves and do the calculations, they've priced in for the next 12 months something around 3.5% is the inflation rate. The inflation's already 6.8%. The markets have so mispriced this thing, I just can't believe it. If you go beyond 12 months, what do we have? You look at the forward curves and they're all going way out 10 years, between 2 and 2.5% inflation. And I already told you, for the persistent rate for the next 4 years, if we used 4 years in the United States, the average would be 7. This means that the bond markets have bought into this transitory supply chain, ad hoc reasoning. They don't understand monetary economics, don't understand the quantity theory of money. They don't, for a variety of reasons, by the way. The biggest reason is that students are now taught post-Keynesian economics, and the post-Keynesian models, even the sophisticated ones, they don't include money. These macroeconomic models that everyone learned, they don't include money. They don't even know what the quantity theory of money is. They, of course, they know who Milton Friedman is because there's an international campaign on to deep six Milton Friedman and all of his ideas, including the quantity theory of money. So if you read the papers, you will not find the word money or money supply as an explanation for inflation. You don't find it in the financial press. This gets back to Hanke's 95% rule. 95% of what you read is either wrong or irrelevant. So it's just absolutely unbelievable. But the markets, these people have skin in the game. There is going to be blood in the streets because the bond market will eventually catch up with this. And there will be such a train wreck, one of the greatest train wrecks in the history of man is going to occur in the bond markets within the next year or 18 months. Now when that happens, that means what will happen? Well, interest rates, I said, follow inflation. Interest rates will go up, and you're going to have massive losses for people holding nominal bonds. This will slop over into the stock market and create, I think, a tremendous disruption in the stock market. Now, if you look at the options market in the United States, the options market are basically pricing in that the S&P will go up 8% next year. It might, but there'll be a very rough ride, I'll tell you that, because there's going to be a lot of disruption once the bond markets start factoring in the fact that this inflation we're witnessing is going to be persistent. So with that, I think I will end my, if I could call them formal remarks. I did have an outline, so I guess it is more or less formal. But at any rate, let's open things up for questioning. Bob?
Okay, Steve, that was really uplifting. Really feeling good after that. Let me ask you about exchange rates. So at least with regard to what we know has happened, we've had a lot higher manifestation of inflation in the United States than in Israel. But your message is just wait. There's going to be a lot more in Israel. But meanwhile, over the last year, there's been a tremendous deterioration of the dollar against the shekel. So I've assumed, I don't know about the stuff like you know about it, so I just work intuitively. And I just assume this is because, relatively speaking, there's been a lot more inflation in the United States than in Israel. And that's played out in the exchange rate. So what should we be thinking about, given what you just said, about the exchange rate, dollar vis-a-vis shekel going forward?
You're talking to an amateur here. we got to get Al Friedberg on.
Okay.
I'm serious when I say this. Actually, Al is the one we want to ask, not me.
About the fact that the Forex is mitigating some of the upside or the excess money for now. It does tend to mitigate it for some time. And if the central bank were to react by trying to hold the dollar from rising, which they're starting to do that more often, they would be creating more shekels still and probably worsen the problem. They probably worsen the money supply problem, the excess money supply problem. But it would take some time. The lags are quite variable, as we know. The lags are very variable. And countries that are experiencing strong Forex performances tend to have a lower rate of inflation in the beginning. They tend to offset some of that excess quantity of money. Just by the same token, countries that have weaker foreign exchange will reflect prices much faster. The excess money will reflect in prices at a much faster rate. So Forex does have a mitigating impact or an aggravating impact in the short term, but it doesn't do much over periods of 2 to 4 years. It doesn't do very much.
So given what Steve was saying about the imminent inflation in Israel, is there something to conclude about the implications on the exchange rate?
Well, generally we tend to believe that you don't intervene in the foreign exchange markets, right? You try to let it ride, try to let it rise. Intervening in the exchange market is distortionary, and it will create a bigger problem eventually. But I don't know if we can make a foreign exchange forecast for now on the Forex rate. Some of that must have been associated, and that's maybe in some way, it's a relative price. Some of it's probably associated with high tech ventures that have succeeded and are bringing in capital in some way, and exits that have taken place in the high tech end and are bringing in capital in some way into the country. So there is a sector that is strong. It's almost as if Israel had some very favorable terms of trade. If they had a commodity that was going up in price, and like oil, and they were selling the oil, that would do something for their foreign exchange rate. But it's not durable, and it's not something that you can count on. But you can also not forecast exchange rate. All you know is that this money will eventually find its way. At some point, it may take longer, but it will find its way into prices.
Okay. Thank you, Doug.
Good.
Back to Steve. I'll tell you, let me ask one more question, and then I'll let our students ask. I just saw the U.S. Federal Reserve was created in 1913. That's when the current system of monetary control that we have now in the United States was set up in 1913. So since 1913, a $1 US dollar in 1913 is today worth 3.6 cents. That's how much inflation there is. That's how much deterioration there has been in the value of the dollar. And that's what we have to say about the quality of managing money of the U.S. Federal Reserve System. I think it's not a very pretty picture. So given that, I'm wondering what your view is about gold standard. If there's a better way to do this business.
Well, let me just say that the gold standard had the variety. Number one, there were lots of different kinds of gold standards. So that was a, when you talk about the gold standard, there are many varieties, kind of a Heinz 57 type of thing with regard to the gold standard. But the thing that the gold standard did was to put a straitjacket on the monetary authorities, the central banks, that constrained them. I mean, they had some discretion, but not as much as they do now. I would prefer any kind of rule-based system that could be enforced that would, in fact, straitjacket the central banks to a greater degree than they are right now. So let me just leave it like that. I mean, you could do, for example, let me give you an example of going to the gold standard. So what would be a modern version of the gold standard? Currency boards would be a modern version. By the way, you can look at, there's a Palestine, before the state of Israel, Palestine had a currency board. And how did that work? It worked exactly like the ones that John Greenwood installed in 1983 in Hong Kong, or the ones I put in Estonia 92, Lithuania 94, Bulgaria 97, and Bosnia 97. And those operate like a gold standard. The mechanics is they're exactly the same, only they have a reserve currency, not gold. So Hong Kong, let's go to Hong Kong. That's the biggest currency board, very important one. Hong Kong issues a Hong Kong dollar. It is fully backed by US dollar reserves. The US dollar is the anchor, not gold. The US dollar is the anchor. It trades at a fixed exchange rate of 7.8 Hong Kong for each US dollar. And it's freely convertible. There are no restrictions on exchange and so forth. So the Hong Kong dollar, it's a clone of the US dollar. So whatever the US monetary policy is, it's reflected exactly in Hong Kong. That mechanically, that's exactly what a gold standard is. So what I would say even for someplace like Israel, they should have a currency board. They should anchor it to the US dollar. They'd be much better off. You wouldn't have to be worrying about the shekel, because the shekel would be a clone of the US dollar, and that would be the end of the story. Or by the way, if you really were keen on gold, you could have a gold-backed currency board. And the gold-backed currency board just might be of interest to people in the audience or listening in. I've recommended a gold-backed currency board for Turkey, Iran, and Russia. And why? Well, Turkey, simply because they have political problems with the United States and with Europe, by the way, even though they're members of NATO. So with Erdogan, maybe the gold would be attractive because it's not issued by a sovereign. It wouldn't be an anchor that's issued by a sovereign. It isn't a liability of anyone. The same, obviously, for Iran, the same for Moscow. They all have their political problems with the two obvious anchors of fiat money, which would be the euro or the US dollar. So why not gold? So that's kind of a long-winded answer, Bob. But that's where I am. Is that most developing countries should either dollarize and get rid of their local currencies completely, or if that isn't feasible and they want a local currency, they should straitjacket their monetary authorities and have no monetary policy and have a currency board in which they have an anchor to either the US dollar or the euro.
Look, I'm inclined to follow up with another question, but I want to give my folks here a chance to answer. But if I was going to ask you another question, my question would be that is predicated on a reliable dollar, and I'm getting less and less confident in a world with a reliable dollar. Please don't answer.
Well, I would just say for the time being, have a good night's sleep and don't worry about it.
Okay, questions?
I'm Simon. I'm a wealth manager in a company what is building, actually. My question is about mentioned about regarding the supply of the money in Israel. I know that at least in Israel, there are no, this is, as far as I know, there are no official publication about the supply of the money. And I would be happy to understand how do you calculate it. Thank you.
Oh, okay, well, no, the Bank of Israel actually provides very good statistics on the money supply, and the measure I'm using, if you go to the Bank of Israel, look for M3. M3 is a broad, what we call a broad measure of money. Now, there are various measures. The money that's produced by the Bank of Israel is called the monetary base, or M sub 0. And that's actually a small portion of the total amount of money. That's a small fraction of M3. I don't know what it is exactly. My guess is it's got to be between 10 and 15% of M3. So most of the money produced in Israel, as is the case every place, including the United States, is private money. It's produced by commercial banks. The big thing people don't understand is the fact that central banks, although they control a game and they're very important in terms of broad money, the money that you put in that equation of exchange, MV equals PY, that M is most of it produced by private banks or by commercial banks. A lot of them are state banks, actually. Not the central bank. So and why do you want to look at a broad measure of money? Because that's what you use as a measure or a model for national income determination. Now, national income determination is just to determine what the course of nominal GDP is. Now, nominal GDP includes the real growth in GDP, plus the residual that's left in the total of the nominal, which would be inflation. So if you want a model, a monetary model that predicts very well the national income, the course of national income, you have to use broad money. It really is a measure of the money held by the public. How much this money is held out there in the public. And M3 is the best measure in Israel, and you get it from the Bank of Israel. It's very accurate. The statistics at the Bank of Israel are very good, very high quality. Yeah.
Hey, thanks so much. One of the founder of the startup. Given the fact that kind of inflation is driven by the money supply, what can the average person or organization do to kind of hedge themselves from inflation? Kind of given the fact that you don't have control of the reserve.
Well, the first thing to go to, and by the way, you go to Al Friedberg's Friedberg Mercantile Group website. You read the quarterly reports, and you'll find out what to do. And what to do is Friedberg's all in on commodities, from gas, the energy sector, and other commodities. So that's the first thing. Remember that sequence that I gave you? The money supply goes up, and the first thing that happened, asset prices go up. Well, what are assets? You got farmland, you got commodities of all sorts, and then later on, and obviously when inflation starts hitting the bond market, you don't want to be in bonds. You want to be in. I haven't looked lately, but I think you have inflation-linked bonds in shekels. So the inflation, and again, you'd have to get advice on exactly what to do. But if you want to be conservative, inflation-linked bonds are okay. Or by the way, it's another thing I would add to that. If you have inflation, unanticipated inflation coming, it's a good time to get a mortgage and buy another house. If you have inflation that's unanticipated coming in, it's a good thing to be a debtor, not a creditor, because the money you pay back on your debt is got much lower purchasing power than the credit that was given to you originally.
Thank you. Hi, Professor Hanke. My name is David, and I wanted to ask you, if possible, if you could elaborate a little bit about the mechanisms for which the central bank in the U.S. actually disperses the money in the economy. I think we all know to a certain degree that they buy securities and they lend to commercial banks, but it seems with the larger increase in the rate of printing, they're using new outlets and it affects different parts of the economy differently. And I was wondering what you think about those mechanisms, if you could explain their effects, and if you think there are better mechanisms than what are currently being used.
Okay, that's a very interesting question, which allows me to say something about that. In the United States, let's go back to the Great Recession in 2008, and the Great Recession occurred, and at the time that it occurred, remember, there were lots of mortgage problems. It was mortgages were going bad. You had the real estate bubble that popped, and so Washington, the politicians always have to react. If something happens that's perceived as bad, the politicians react. And the reaction was to blame the bankers and banks for all these problems. And so we had something called the Dodd-Frank Legislation. And the Dodd-Frank Legislation, in summary, started regulating much more heavily banks. And so we started the Great Recession, and we had this Washington reaction with the Dodd-Frank legislation constraining banks and increasing the capital asset ratios of banks. Also, we had Basel III coming to increase the capital asset ratios at about the same time. This amounted to a pro-cyclical policy. What do you learn in economics? You learn if you want an anti-cyclical. If the economy starts going down, you want to goose the economy with increases in the money supply or increases in the fiscal deficit. You don't want a pro-cyclical policy where you tighten up the money supply and tighten up the fiscal reins on things. But what we did, we had, in fact, with Dodd-Frank, we had a pro-cyclical policy. So at the time, 91% of all the broad money being produced in the economy was being produced by commercial banks. And Dodd-Frank comes and strangles them. And you actually had the money supply actually was going down. The bank money, what I call bank money, was negative. It was diving down. The Fed realized this, and the state money, that's the high-powered money, or M sub 0, produced by the Fed, they started what they called quantitative easing. Quantitative easing 1, 2, and 3. We had three bangs of quantitative easing. Now, what that did, that expanded tremendously the balance sheet of the Fed. And I'm getting to your question, your critical question here. Now, how did they do that? They bought bonds from the broker dealers in the private sector. So the government issues debt. The bonds go to the broker dealers. The broker dealers buy them, and the Fed buys them back from the broker dealers. And when they do that, they credit whoever the owners are of those bonds. What we call the non-bank public sector gets credited. that increases the money supply because somebody in the private sector owned those bonds. And when they sold them back to the Fed, the Fed credits their account. So that increases the money supply. If we hadn't had quantitative easing 1, 2, and 3, we would have had a Great Depression in the United States. So it was a very good thing that we had that. Ben Bernanke was the chairman of the Federal Reserve at the time. So that same process happened in the United States. It happened also in the United Kingdom. That's the way they did it. This gets to your question is very, very important actually. So the UK and the United States, that's the way they increase the money supply. The Eurozone and in Japan, they had quantitative easing, but they didn't buy the bonds the same way. They bought the bonds not from the non-bank public, but the banks in the system. And it did nothing to increase the money supply. All it did, it was like a swap. The banks gave the bonds they had to the Fed. The Fed put those bonds on their balance sheet as assets, and they increased their liabilities. Of course, with the accounting equation, assets have to equal liabilities plus net worth. They increased their liabilities. And what were those increases in liabilities? That was just increasing the reserves of the banks. It didn't increase the money supply, it increased the reserves. So notice those two completely different ways of quantitative easing. One in the United States and the United Kingdom, the second in Japan and the Eurozone. And that's why they had so much trouble in the Eurozone and Japan. They never increased the money. They were engaged in huge quantitative easing, by the way, but the money supply, broadly measured, was not increasing very much. So that's the answer to what, in fact, is a very interesting question. The mechanics of how you increase the money supply, and those mechanics are very important.
Hi, my name is Menashe. I'm a law economics student, and I would like to ask you about Bitcoin and another cryptocurrency as a solution for the inflation. Is something that we can use to hedge, or even as a substitute that can give us like solution and more predicted inflation rate.
Okay, that's also an interesting question. Bitcoin, number one, if it's a highly speculative asset, and it's a highly speculative asset in the sense that the price is very volatile, it goes all over the place, and of course to predict it is a fool's game, and I think it's highly manipulated by. There are a few whales that own most of the Bitcoin, by the way, and the whales manipulate the market. That's one reason that it's so volatile. So if you like to go to the casino and gamble, Bitcoin is the place to be, because that's what you're doing. It's like the roulette. And in a way, the house holds the cards because the whales control the market. Now, it is used in transactions, but very tiny amounts are actually used in transactions. And about 50% of those are used for money laundering and illegal purposes. So it is definitely not a currency, by the way. To be a currency, you have to have something that is a relatively stable unit of account. If it's voluntarily used as a currency, if it's involuntarily used, it could be used as legal tender, by the way, or forced tender. And if they force you to use it, well, you have to use it, whether it's volatile or not, or whether it's a stable unit of account. So that's my thinking about Bitcoin per se. Now there are other kinds of cryptocurrencies, of course. Not Bitcoin is only one kind.
I would like maybe to focus my question, because I don't think that the specific example of the Bitcoin, like people believe in the thing behind it, we think that it will not continue to be the way that it now. But maybe if you can just talk about the technology, when you can make some kind of currency that have stable inflation rate. What do you think about this one, if it can be regulated?
Well, I think most of the Bitcoin arguments are just nonsense, to tell you the truth. So again, if you like to gamble and you like the casino and you want to roll a dice, that's fine. You're a free person. You're completely free to do it. But if anyone asked me about it, I would say, you know, if that's what you like to do, that's your personal preference. You're free to do it. Whatever your gambling budget is, you put it off and, you know, use Bitcoin or whatever other stable coin, Tether or whatever you want to do. But that's what you're doing. You're not investing, and you're not certainly protecting yourself against inflation. It is not a known inflation hedge.
Hi, my name is Joe. I'm the floor manager. That's right. Inflation is all about supply money, as you said. So how come in the first 3 QEs in the United States we didn't see?
A little bit louder, please. I'm having trouble hearing on the microphone.
Okay, you hear me now? Okay.
If inflation is all about supply of money, so how come in the first 3 QEs in the United States we didn't see a big growth in inflation?
Well, okay, we didn't see one. Let me go through the gradient. Most people are confused about this, especially gold bugs and people. Some people actually said that quantitative easing 1, 2, and 3 would lead to hyperinflation, they said. It did not, because remember, when it started, the Fed was only producing about 9% of the total broad money in the economy was produced by the Fed. Most of it was produced privately by commercial banks. So even with quantitative easing, at the maximum contribution of the Fed to the broad money supply, it only reached 18% of the total. And that just mitigated the fall that was occurring in the money supply produced by banks. So if you look at the money supply in the Great Recession, it never grew by more than about 4 or 5%. The rate of growth, and even with the 3 quantitative easings, it never got up above about 5%. We had very slow monetary growth during the Great Recession, and that's why the Great Recession was strung out. It lasted so long. The monetary growth was too slow. And that's why they kept complaining, we can't hit the inflation target of 2%. We can't hit the inflation target of 2%. Of course they couldn't, because the money supply wasn't growing very fast. The money supply would have had to have been growing 6% or greater to hit that 2% target. It was growing too slow. Now, and the problem is these central banks do not pay attention to the money supply. In February of this year, Chairman Jerome Powell testified before the Senate, and in a back and forth conversation he had with Senator Kennedy from Louisiana, Chairman Powell actually said, M-2, we have to unlearn what Milton Friedman taught us with the quantity theory of money, because the money supply doesn't have anything to do with inflation anymore. He actually said that in testimony. So they don't look at it. And if you look, for example, the Bank of England, Greenwood and I have looked at their quarterly inflation reports to see when the last time the word money or M4X or M3 or any of these M's was mentioned. We have to go all the way back to 2018. It isn't even mentioned in the reports.
Okay, last question, last question.
Hi, I'm Eyal, a management consultant and interested in Middle Eastern economies. I was just interested to hear your view and outlook of the Lebanese economy. You said a 60-second hyperinflation case. In light that they're probably not going to build a currency for it anytime soon. So I'd be interested to hear your outlook on that country.
Well, if you go back to the Wall Street Journal, and I can give you a reference that Bob can, or you can just email me. Hanke, if anyone wants any questions or they want information, Hanke at jhu.edu. Now, Jacques de la Rosière, the good family friend and former managing director of the IMF and former president of eBird and former governor of the Banque de France. And I wrote an op-ed in the Wall Street Journal a few months back proposing a currency board for Lebanon. And let me just say that would solve the problem. Within 30 days, everything would be fixed. And the proposal is, let's say, in circulation. That's all I can say right now. But it's the proposal is still alive and well, and that would fix the problem in Lebanon immediately. But as you know, politics is a murky and dangerous game in Lebanon.
Absolutely.
Okay.
Bob, was there one other person that wanted to ask something, Bob? I think that fellow in the gray sweater wanted to ask something.
Where's the fellow in the gray sweater?
There was somebody in the front row.
Yeah. Okay.
Maybe it wasn't a gray sweater. It was a black T-shirt.
Okay.
Yeah. Okay. Yeah. You're the one I saw you wanted to ask something.
Yeah. Thank you. Okay. Do you hear me?
Yes, I hear you.
Okay, thank you very much. So my question is like that. We see that the stock market is booming on the one hand, and on the other hand, we are talking about the money supply that it's growing ever since March. So how much do you think it's related in each other? Like maybe the stocks are not producing as much value, but are keeping the same value in terms of that there are more money, and therefore the value is raised.
I think this, again, the money supply goes up within 1 to 9 months, asset prices start booming. That's where we're at right now. Where I anticipate, and as I said, in the United States, I don't follow the market in Israel, so I don't know anything about it, really. I'm not knowledgeable. But in the US, the options market is pricing in an expectation of about an 8% increase in the S&P index next year. Now, I think that the market is mispricing the inflation risk completely, and I think once it starts pricing in the reality of persistent inflation, interest rates will go up significantly. There'll be a lot of disruption in the bond market, and what that means is inflation goes up, the PE ratios will come way off, the multiples will come way down. So this suggests to me that in general that is a negative. I'm not saying that particular companies, again, it's like relative prices. The S&P index is a basket, but there are a lot of stocks in the basket. So some of those are going up, some are going down. And you're asking the question, well, where's the basket going to go? And the options market's saying it's going up, and I'm saying I'm not completely convinced about that, because I don't think the bond market is priced in the inflation, and we're going to have a real train wreck in the bond market. And if I'm correct, which I'm almost certain that I will be, the multiples will come way off in the market, and the basket will come down.
You know, I'm just wondering, considering what you just said about Powell, how can we possibly have any confidence in this guy that going forward he's not going to continue to mess things up?
Well, we shouldn't have, Bob, we shouldn't have any confidence either in him or the president that he gets an F grade for what he's done with all this excess money in the bathtub. And the president of the United States reappoints him to be the chairman again after he should have given him an F grade, and that would have been the end of it. He gave him an A and reappointed him.
So it sounds like we're talking about a lot more bad news.
Yes.
Okay. Great presentation, Steve. Thank you so much.